everybody, Luke Gromen, founder and president of Forest for the Trees, FFTT. Hope everybody had a great week. Certainly had a beautiful weekend here in sunny and beautiful Cleveland, Ohio. Attended some baseball games for my son and track meets for one of my other sons. So it's been a great week, and as you can see, it's a little hard on the head for those of us that don't have hair, but that's a happy problem. So I'm going to jump right into the two things here real quick. First off, the two things that grabbed my attention this week. Number one, Saudi Arabia is threatening to sell its oil in currencies other than the dollar if Washington passes a bill exposing OPEC members to U.S. antitrust lawsuits. Some people have noted that this is something Saudi has threatened before over the past 40 years. I think that's correct. However, they've never threatened it when there's a viable alternative oil contract in non-dollars that was trading, as is now the case in the yuan oil contract. They've never done it when the U.S. was not their biggest customer, as is the case now, where China is now Saudi's biggest customer, not the U.S. And so it makes it very different than these prior 40 years, which is not something I've seen a lot of people acknowledge. But it's particularly also interesting in terms of the timing in light of the U.S.-China trade deal. We continue to believe, based on what we've been told, that Saudi pricing oil in yuan is an inevitability. We've heard as much, and ironically, it makes sense. If you're a capitalist, the way things typically work in capitalism is when your biggest customer wants to invoice in certain terms, you tend to yield to that biggest customer. Ask Amazon, ask Walmart, etc. So, ironically, for capitalist reasons is the reason we're hearing what we're hearing vis-a-vis the eventuality of Saudi pricing oil in yuan. Secondly, the other thing that really grabbed me this week was towards the end of the week, President Trump said a, quote, very monumental trade deal may be announced in 4 weeks. Now, you got to take this one, in my opinion, with a grain of salt, given the president's tendency for superlatives, sometimes warranted, sometimes not. The thing that really grabbed me about it is virtually nobody is noticing that Treasury Secretary Mnuchin and PBOC Governor Yi are centrally involved in the negotiations and are purportedly, according to the Wall Street Journal and New York Times, discussing cybersecurity, which is curious because I would suspect that neither gentleman is in the top 1,000 of cybersecurity experts in either man's respective countries. And so I think it's a critical factor to be aware of in light of President Trump's comment about a monumental deal for FX markets, for risk markets. I think what's being negotiated, at least in part, is a currency deal. I think that's why Yi and why Mnuchin are involved. And if it is a currency deal, it would in all likelihood be one that weakens the dollar if you're trying to improve the trade balance. And so stocks are acting like a dollar weakening trade deal is coming. The U.S. Treasury market is acting like it is not coming. And so I think it's going to be a critical thing to get right. Everybody is focused on, or virtually everybody is focused on mechanical reasons for dollar strength. Virtually no one's focused on the binary political headline risk to being long dollars, which is the possibility that a trade deal will weaken the dollar on a binary basis, over a weekend when it's announced. So something to be aware of. 3 questions here real quick I'm going to highlight from Peter. How can gold be turned into dollar liquidity? Can I explain, please? The short version is that China or Russia or both, in extremis, and again this is important, in extremis, can declare that physical gold will be valued by their central banks at, say, $5,000 per ounce for Chinese goods or for Russian oil. That would generate all the dollar liquidity they'd need. This is not a move I think they would take unless it was in extremis, but it's absolutely a move that in extremis, faced with starving for lack of dollars or doing this, you gotta believe this is something they would do. Second question from Jose. What is the short-term end-of-year bullish dollar thesis? It seems that if the Fed does indeed pause hiking, the U.S.-China deal gets done, and Europe/China rebound, then the dollar should start falling a tad. Right now, the bullish case from a short-term perspective is purely mechanical, which is that as long as foreign central banks are no longer growing their holdings of treasuries, foreign and domestic private sector must finance growing U.S. deficits, which this, all else equal, will crowd out the global private sector as it has a finite, the private sector has a finite balance sheet, and they mark their holdings to market, so they can't take losses. without having pain like foreign central banks can. So the bottom line is the foreign central banks aren't buying treasuries. The domestic private sector must buy most of them, and that crowds out the global private sector, causes a global dollar shortage as you can buy iPhones or you can buy cars or you can buy treasuries, which is an oversimplification but illustrates. And so you see LIBOR rise, you see the dollar rise. And so that is really why it would be dollar positive in terms of the short-term mechanical. I agree with you that a China deal likely would be dollar negative and risk positive, as we noted prior. I would also think, your point on rebounds in China or the EU would probably also be, all else equal, probably negative for the dollar on the margin. And the last question from Thesaurus, what is meant by the phrase China needs dollar liquidity? How does China's recent gold purchases play into it? China's short dollars. They borrowed. They have significant debt denominated in dollars. In my opinion, how it ties into the gold purchases is really, I think it's not direct. I think the gold purchases that the central bank has recently begun buying again is more signaling. It does, as we noted earlier, create significant flexibility in case of trade or otherwise kinetic confrontation with the U.S. getting more intense, as we noted earlier. I do also think that gold is being used as a governor and how far the yuan can fall versus the dollar. This is a dynamic that I've not seen a lot of people talk about, but over the last 3 years, every time the yuan dollar nears 7, London and New York begin to hemorrhage gold, 80 to 120 tons per month. Those are not losses of tons that they can sustain for that long a period of time without really impacting gold markets. And so it seems like the way China has set this system up has been that the physical gold markets are being used as a governor on how far the yuan dollar can fall. And so that's where I think is going on there. So I'm going to leave it at that. In the meantime, check out FFTT-LLC.com. Been getting great feedback on our tree rings product. And at any rate, look forward to talking with you all soon. Hope everybody has a great weekend, and we will talk with you soon. Take care, everybody.